Hi, I am going to present you a first home buyer's guide. In this guide, we will cover process and the journey of buying a first home. We will discuss some important must-do, unlock jargons and terminologies used in property and mortgage world. Discuss how to find out budget and price range of the property you can buy. Do not forget to save this video for your future reference. You can check the chapters of this video in description if you want the information regarding something specific. Also subscribe this channel and click on bell icon for more up-to-date information of property and mortgage world. Before we start, please note that this information is intended to be general in nature and is not personal financial product advice. It does not take into account your objectives, financial situation or needs. Eligibility and qualifying criteria apply. Please seek professional advice and assessment before making any decisions. I am Ruben Sohana from Win Square Finance. To book a meeting with me, please visit our website winsqfin.com.au, or you can scan the QR code at any time during this video. Alternatively, you can call me on 0488882750. Let's start with the process and journey. First thing, keep your credit record clean and save the deposit. Get your borrowing capacity assessment done and get pre-approval for the loan. We will talk further in this guide about the price range of property you can buy. Find a suitable property as per your budget. Get the contract of sale reviewed by a conveyancer or a solicitor. Sign the contract of sale and pay the deposit. Make sure contract of sale has cooling off period. Once you sign, the cooling off period starts and you should do the final checks. Get pest and structure inspection done, valuation done, and try to get the formal approval within cooling off period. If it's an auction, get inspections done, consult mortgage broker and conveyancer or solicitor before registering to bid. When cooling off period or auction finishes, contracts are exchanged. Your signed contract goes to vendor and vendor's signed contract comes to you. That's referred as contracts exchanged. After formal approval, you get the loan documents to sign. You sign loan documents, set up accounts, etc. Deposit shortfall monies and the settlement is booked. Final day you do the pre-settlement inspection, settlement is completed. And you get the fees. Must-dos. You must get the loan pre-approval. You must get the contract of sale reviewed by conveyancer or solicitor. You must get a cooling off period. You should get the valuation, inspections and formal approval done within cooling off period. Must consult conveyancer and mortgage broker to make sure everything in contract is good and property is acceptable by the lender, as some lenders do not accept some properties. If it's an auction, you do not get cooling off period and cannot amend any terms and conditions of contract once bidding starts, or you have registered to bid. So I would emphasize few things you must do before you bid. Loan pre-approval and accordingly decide your maximum bid. Consult your mortgage broker to discuss if the property is acceptable by lender and impact of overbidding because your loan product may have limitations. Consult your conveyancer or solicitor to review contract of sale, get the building, pest and structure inspections done. Negotiate of term or conditions, for example, longer settlement period, lower deposit than standard or any other changes in contract of sales must be agreed well in time and in writing before you register to bid in the auction. You are bound to the contract of sale once you have the winning bid, even if you do not sign the contract of sale. Yes, that is the condition of registering for the auction. As from the conversation till now, you would know the professionals you need your side are mortgage broker, conveyancer or solicitor, building and pest inspectors. Some people like to use buyer's agent, so that's optional. You may like to discuss your purchase with your accountant, especially if you are planning to change your property into the investment in foreseeable future. Grants and schemes available for first home buyers. Federal and state governments support first home buyers through different grants and schemes. This includes First Home Buyer Guarantee, Family Home Guarantee, Regional First Home Buyer Guarantee. These are federal government schemes and are available for all permanent residents and citizens of Australia as of August 2023. State governments offer first home buyer grants, stamp duty exemptions and land tax schemes. Availability of these schemes depends on the state you are a resident of, or you have intentions to be the resident of, and buying your first primary residence there. I will do the detailed videos for this. Please look for these videos on Win Square Finance's channel for detailed information of all schemes available in your state. Now it's the time to unlock some jargons and terminologies used in property and mortgage world. If you are familiar with few of these, I will still recommend listen these carefully as there might be some of those you do not know about. Conveyancers versus solicitors. Both solicitors and conveyancers have the ability to prepare the paperwork and offer legal advice about the purchase of your property. However, conveyancers are not lawyers. Instead, conveyancers are professionals licensed by the state regulator who can help you with all the elements of your property purchase. Only solicitors are fully fledged lawyers. Lawyers can be conveyancers. Contract of sale, usually referred as COS in emails, etc. In most states and territories, it's mandatory for the vendor to have a draft contract of sale prepared before real estate agent can advertise the property for sale. Contract of sale outlines all inclusions, exclusions, all terms and conditions, for example, deposit percentage, settlement period, as well as all the required information about vendor, property, sales agent, and solicitor, etc. It's also mandatory to make a copy of contract of sale available to any potential buyer upon request. As discussed, before you sign, you should get it reviewed by property law expert. Joint tenants. If the owners buy the property as joint tenants, then they jointly own the property without specific share. If any of the joint owner dies, then the ownership of the property would pass to the survivor automatically. The deceased's interest in the property would not be dealt with under the terms of their will. This is common and default structure for most married couples when they jointly buy a property. Check with legal expert for details. Tenants in common. If the owners buy the property as tenants in common, then they would each own a share in the property. The share that is owned by each of the owners can be equal, that is 50-50, or unequal in whatever proportions are selected. For example, one owns 5% and other 95% or 30-70, etc. Some lenders would require co-borrower to own certain minimum share in the property. In this structure, if any of the owner of the property dies, then their share of the property would be dealt with under their will and or probate. It would not pass automatically to the other owners of the property. Please check with the legal expert for more details. Cooling off or due diligence period or finance clause. Cooling off or due diligence is usually a 10-day period that starts from the day of signing the contract. There may be shorter or longer or no cooling off period in a contract. Cooling off period gives buyer an opportunity to go through final checks, valuation, building inspections, get final loan approval, etc. If any of the checks fail, buyer can back off from the deal within this period. Finance clause is usually a clause in contract that this deal is subject to approval of finance. In case of rejection of finance, buyer would not have any obligation and can back off from the deal. One thing you need to be aware of is that despite cooling off or finance clause, there might be some financial loss to you. So always get contract reviewed by property law expert before signing. LVR. LVR is loan to value ratio. Formula to calculate this is loan amount divided by value of property and multiply by 100. So if you are taking a loan of $400,000 on a property valued $500,000, your LVR is 80%. Standard LVR for residential properties is 80%. If your LVR is over 80%, either you should be eligible for lender's offer or government schemes or be ready to pay or add LMI to your loan. Some lenders for certain properties may ask for LMI or risk fees to be paid even if LVR is lower than 80%. LMI. LMI stands for Lender's Mortgage Insurance. Lender's Mortgage Insurance is a one-off, non-refundable, non-transferable premium that is added to your home loan. It's calculated based on the size of your deposit, value of property, and how much you are borrowing. The more you contribute to the purchase price of your property, the lower the cost of LMI will be. LMI protects the lender against any loss it may incur if you are unable to repay your loan. It does not give borrower any protection. You will have to pay LMI or add it to your loan amount. If you have less than 20% deposit and you are not eligible for government schemes or lenders offers as explained before, even if you have more than 20% deposit, LMI may still be applicable as per lender's policy. I will do another video to elaborate how LMI is added to your loan. Variable interest. Variable interest rate means if interest rates go up, your interest rate goes up. If interest rates go down, your interest rate goes down. Fixed interest rate. You can choose to fix your interest for 1 to 5 years term. Within that term, if interest rates go up, your interest rate stays same. If interest rates go down, still your interest rate stays same. Now our next point is split loans. If you decide to fix part of your loan and keep part of it variable, then loan need to be split into 2 or more parts. You may split your loan for accounting or management reasons as well. Break fee or costs. There is a fee charged by lender if you break a fixed rate mortgage. Break fees is higher if interest rate have come down since you fixed your interest rate. Rate lock. To understand what the rate lock is, you would need to understand why it is required. If you opted for fixed interest rate at the time of the loan application, and if rate changes by the time of settlement, rate at the time of settlement is applied to your loan. Lenders provide you with the provision to rate lock the fixed interest rate you want to apply for. Different lenders charge different rate lock fees, and it's locked for 3 months from the day of application to the day of settlement. Very few lenders lock rate for you at the time of application without any fees. Offset account. Offset account is a separate transaction account linked to your loan. It reduces your interest payable as interest is payable on net balance. For example, if your loan is $500,000, money in offset account is $100,000, interest is charged on $400,000. Redraw facility. If you make extra repayment to your loan, not in the offset account but deposited into the loan account. If you have redraw facility, you can redraw any extra money deposited or extra repayments made to the loan. Some lenders would hold one extra repayment when you want to redraw. So if you had paid $10,000 extra, your regular repayment is $2,000, you can redraw only $8,000. Most variable interest loans give you flexibility to make unlimited extra repayments. Most fixed interest rate loans come with limited or no extra repayments options. P&I. P&I is referred to principal and interest repayments. In this loan arrangement, you pay interest as well as repay part of the principal amount you borrowed. Interest-only repayments, sometimes mentioned as IO. In this loan arrangement, you pay only interest portion for the set term on the amount you borrowed. 1 to 5 year interest-only periods are usually offered by lenders on investment loans. Interest-only loan for primary residence is not commonly offered by lenders, and even for investment properties, more than 5 years interest-only is very rare. DTI. DTI stands for debt to income ratio. Formula to calculate this is total debt divided by income. So if your debts are $500,000 and income is $100,000, your DTI is 5. Some lenders limit lending based on DTI. Assessment rate. This is a government regulation under responsible lending. When lenders do the assessment of your borrowing capacity, they need to add a buffer to actual interest rate, so that if interest rate increases, you do not face any financial hardship to pay the loan. Most major lenders also have minimum floor rate to check your borrowing capacity. Now take an example. If actual interest rate is 4% and lender puts the buffer of 3%, assessment of your borrowing capacity is assessed with 7% interest rate. And if lender has 8% floor rate for assessment, your borrowing capacity is assessed with 8% interest rate. Shredding or haircut of income. This is also part of responsible lending obligations. If you get bonus, commission, overtime, RSUs, dividends, overseas income, etc., lender may decrease this income by 10 to 40% for the assessment of your borrowing capacity. Some lenders may not shred some of these incomes. Some may not use some of these incomes at all. Valuations. Lender requires the valuation of the security property to be done by their own approved valuer. Many major lenders would not charge client for residential property valuation. Your mortgage broker can apply this for you. There are several different ways how the valuation of the property is done. Lender or their valuer decide how they want to do the valuation. First and fastest way is AVM, Automated Valuation Model. This is a system generated valuation report. Next is desktop valuation. By using property data, a valuer can do this valuation from a desk without physically visiting the property. Next is curbside valuation. It is also known as drive-by valuation and is a faster alternative to the full valuation. Valuer visits the property but don't need the access to go inside. Next is full valuation. It is also known as short form valuation. Valuer requires full internal and external access for inspection of the property. Now, the million-dollar question that every first home buyer asks: how much money I can borrow and up to what is the price range of the property that I can buy, so that accordingly they can decide on the location and size of the property they can buy. First and all, mortgage brokers are there to work out your borrowing capacity and work out the deposit you require to buy the property or the price range of the property you can buy as per available cash and your borrowing capacity. We at Win Square Finance charge no fees. To assess your borrowing capacity, work out all other stuff and apply your loan. But how all this works? To understand this, you need to understand the 4 C's: character, capacity, capital, and collateral. You need to know what LVR is. If you have not, then go back to previous part of this video to check what LVR is. You also need to have knowledge of grant and schemes available to support first home buyers. I am doing another video to explain grants and schemes. Please check that. I would emphasize all 4 C's. Let's unlock this along with some case studies. The first and very critical C is character. Your character is assessed by the lender looking at your comprehensive credit report. Lenders look at your credit history, your credit score, your record of repayments of any loans or credit cards, and they also look at any bad debts or unpaid bills, etc. No matter how good capacity and capital you have, if credit character is not good, a good lender may not lend you the money. You may be eligible to get free credit report for yourself from Equifax. Capacity. Capacity is your borrowing capacity. It depends on your income, your liabilities, your living expenses, etc. Borrowing calculators are there on our website and several other websites. I would recommend do not rely on them. Get full assessment done by a mortgage broker. We at Win Square Finance and do obligation-free full assessment of your borrowing capacity. Next C is your capital. Capital is your savings or the cash that you have available for the deposit plus if stamp duty applicable and other expenses. If you have great borrowing capacity but do not have minimum required capital to contribute to the purchase, it would not be easy to borrow money to buy the property. Final and big C is collateral. Big C because collateral is property pledged to the lender. It must be a type of property that is acceptable to the lender. For example, certain apartments and units or farms bigger than certain sizes. Kit homes or manufactured houses and some types of titles are not acceptable by many lenders. Many lenders do not lend for certain properties in certain postcodes. That's why I explained previously why you must consult your mortgage broker before committing to the purchase. Value of the property is considered as per lender's own valuation. I have explained valuations previously in this video. Reminder, these case studies are just to satisfy your curiosity. You do not need to do these calculations yourself. We at Win Square Finance can do these calculations and assessments obligation and cost free. Case study 1. Say you and the property you are buying are eligible and qualify for stamp duty and LMI exemption when buying 95% LVR. That is 95% loan and 5% deposit. Your broker has confirmed that you have $300,000 borrowing capacity. You have savings of $17,000 and want to find out upward price range of property you can buy. To do this, I usually first deduct $5,000 for other expenses and start with $12,000 as available for deposit. Now we divide deposit available $12,000 by the percentage of deposit required, that is 5, and multiply by 100, and that equals to $240,000. $240,000 is the maximum price range of property you can buy because you are restricted by capital available. If you are liable for stamp duty and or LMI, For high-level calculations, we will add percentage of deposit required 5 plus 4 for stamp duty and plus 3 for LMI and total of this, which is 12. Now I will divide available cash for deposit $12,000 by 12 and multiply with 100. In this case, maximum price range of property you can buy would be $100,000. Despite the borrowing capacity of $300,000 because of limited capital available. Case study 2. How to find out capital and deposit required once your broker has told you your borrowing capacity. Again, we assume that property you are buying and you qualify for 95% LVR, that means 95% loan, and 5% is the minimum deposit required. We again assume your borrowing capacity is $300,000. Now to work out capital required, we take your borrowing capacity $300,000 divided by LVR 95 and multiply with 100, that equals to $315,789. That's the maximum property price you can buy, subject to the capital. To work out capital, say you find property exactly worth $315,789. Multiply by minimum percentage of deposit required and divide by 100. That's $15,790 the deposit you would need. Add minimum $5,000 for other expenses, that would become $20,790. Plus stamp duty if applicable, plus LMI if applicable, and if it cannot be added to loan over 95% LVR. That would be minimum the capital required to buy the property. If you have more than minimum capital required, you can contribute more to the purchase. In that case, you can have better LVR and maybe higher budget too. Final 3 reminders. You do not need to work out all this. Mortgage brokers exist to help you, guide you. We at Win Square Finance charge no fees to assess your borrowing capacity, work out things for you, and apply your loan. There are grants and schemes available to support first home buyers. You may be eligible for stamp duty exemption and LMI exemption under government support for first home buyers. We have detailed videos on this channel to explain these benefits. Congratulations! Now you can hold a property conversation like a pro. For any questions, you can book a meeting with me by scanning the barcode or by visiting our website winsqfin.com.au or call me on 0488882750. Don't forget to subscribe this channel for more informative videos. Thank you.